Welcome to the Warlords of Wall Street. Well, today was another hectic day in the market as the latest drama with Credit Suisse played out. Turns out that one of their largest shareholders, the Saudi royal family, who already owns 9.99% with a policy not to go beyond 10%, came public and said that they would not be adding any more to their position. That seemed to bother the market, despite its chairman coming out and telling everyone that its liquidity was fine. There were a couple of other regulators out of Switzerland that reiterated the same story. That was interesting, and yet the stock has found an all-time low that was below $2 a share. I have to tell you that it's tempting. Even the regulators in Switzerland said they would do whatever they needed to do to assure its stability, and yet all the numbers in the financials look pretty good to me. But sometimes when you're out of favor, you're out of favor. When the rumors out there that you're in trouble, blood is in the water, and Credit Suisse has enjoyed an elite status in the European banking community, the world banking community, for decades and decades and decades. It may be just someone trying to make a play for this, may end up being what ends up happening, but I kind of like it here, right around the $1.75 to $2 range. I think it's worth taking a chance with a little bit of discretionary money that you can afford to be live dangerous with. We saw oil drop below $70. So that was interesting. West Texas Intermediate was right down around $68, $69 most of the day. It dropped even into the 67 range. We saw a crack 7. That was interesting. Had a couple of pieces of good news come out today. Mortgage rates have pulled back, along with the treasuries, of course. That sent home builder sentiment up, which is not necessarily a bad thing, just so long as the sales don't go rocketing. But I think there's a chance we might actually see that. It's a correlated relationship. Rates go down, people start financing again. The 10-year, which was sitting at 4% not just a week ago, is now around 3.4. You've got your 2-year sitting around 3.8. This is really important because the inversion was north of 1 whole point not a week or so ago. Now we're down to less than 0.5%, and I like that. Matter of fact, the Fed loves it. I love that. The closer this inversion, the more it narrows, and then eventually returns to normal. Of course, the 10-year ought to be paying a higher interest rate than a 2-year note. This is just a sign of normalization coming back. I see that as a very strong positive. Another good sign that came out today, the PPI. It was down 10 basis points, and the estimate was for it to be up 30 basis points, or 0.3, if you will. The inventory numbers were down just a fraction for the PPI. On top of that, that's telling you that the manufacturers who are making a lot of the goods, their supply lines, although they are still claiming that their supply lines are a bit challenged, they've got their inventories down just a fraction. That's the first time since 2021 that we've actually seen inventory levels drop a little bit, which is good management on their part, because that was one of the criticisms of late, is that inventories were exploding. Now, to say that inventories were down 0.1%, that's not anything to beat the drum about, but when the projections were, the estimates were for it to be up 0.3, and you're down 0.1, that's going in the right direction. And with the PPI, they expected it would be up. It's down. That's going in the right direction. Add all of the chaos that the regional banks have been going through of late, and I don't think you're going to see Powell do much more than 0.25 of a point. I think he still has to be honest with you, because inflation still is an issue. However, I think when he hits the microphone, I think you're going to hear a whole different tone come out of him, and I'd be curious to see if I'm right about this. I think we'll bring a quarter of a point, but at this juncture, I think that he's going to be suggesting that the data is pointing that everything is going good. I think he has to assure the market, because the banks are the foundational underpinning of the market's health. And right now there's a lot of question, especially about the regional banks and even the big guys. The big money center banks are taking a bit of a beating, and that is not what he wants. He realizes that, and this is SVB, using this as a prime example, even Silicon Valley Bank, highly aggressive in its lending practices, doing a lot of startup ventures and what have you, big-time venture capitalists. Well, if you can imagine, half of their book is incredibly aggressive loans. And so that the regulators don't have a problem when they come in and look at that, what they did is they literally matched those loans with government securities. So when a regulator would come in and he would start to critique their aggressive lending practices, they would turn around and say, we have perfectly offset and balanced our portfolio with government securities. Look at this. And up until just not so many months ago, no regulator would have per se had a problem with that. He would have been questioning the concentration, but there could be no doubt that the bank was being prudent in its management and that it's balanced its portfolio, barbell effect, with government bonds, the safest asset on earth, very conservative. A regulator would have walked away and he would have been all right. He wouldn't have been per se concerned. But a funny thing happened over the last year, didn't it? The Fed has gone and raised rates by almost 4.5%, 5% at this point, 5 points. And what was a good-looking bond that had its nose above water at maybe 1% or so, now that bond its value is underwater, because the bonds today you can go out and get at 4.5%, 5%, give or take, or 5% last week, 4.5% now. So all of a sudden, it is the Fed's monetary policy that has actually facilitated this drama on the bank's books. 1 minute, you've got a security that looks like it's worth par, it's as good as gold, and the next minute it's not. It's worth, a third of what it was, just because of what the Fed's monetary policy is. That's not the bank's fault, and it's very hard to manage around that, given the fact that the Fed has been so aggressive and so quick in moving rates up. Now, the only critique I would have for the boys over at SVB is that they didn't have really great bond experts managing that position, because you could see it coming, that you knew the Fed was going to start raising rates, and you had to do a better job of getting rid of those bonds and rebalancing your bond portfolio to take advantage of what was coming. Because they didn't, well, then, of course, they got their heads smashed. But I would argue that most of the banks are in that position, and most of you are too young to remember, but I'm going to take you back into the late 70s, early 80s, when you had the savings and loan crisis, the collapse of the savings and loans back then. And what facilitated that is, one day the federal government said that savings and loans and banks could invest in corporate bonds that were and sovereign bonds that were not rated any higher than a B. And if you bought something that was a triple C on a Moody's or a Standard & Poor's, some type of a credit rating of that sort, a single B, a double B rated bond at the time, and you paid $1,000 for it and it yielded whatever it yielded, that's what you carried it on the books for, because that's what it was trading for at that time. That was its value. Overnight, the federal government decided that it would no longer allow banks to invest in anything that wasn't at least triple B or higher. And that became known as bank grade. And overnight, the government, by changing this regulation, literally created the S&L crisis, because they said if it wasn't triple B, you had to write it off in its entirety. Didn't matter that it was worth the same money it was the day before, but because of its credit rating, you weren't allowed to carry it on your books anymore at its face value. That affected the liquidity and the solvency of all the S&Ls literally overnight, and the S&Ls were more aggressive about their portfolios in bonds at that time. So it was the government that created the problem with its policies. It wasn't mismanagement per se, and that's exactly what we're dealing with here. And yet, stooge Elizabeth Warren comes out, and she is barking about more and more regulation. More and more regulation isn't the problem. It is the monetary policies. In fact, it's the regulation that ended up causing the S&L crisis. These are policy changes, and they should have given the banks a much greater notice of that. They should have been Powell should have been sitting down with all the banks and say, hey, this is coming. He should have told the banking regulators, this is coming. So what do we do in anticipation of it? Because we're going to have a negative effect on these banks. Who knows if those conversations happened? I don't think they did. If they did, well, then some of the bankers are to blame because they should have seen it coming. Last but not least, we made a couple of trades the other day, which was fine. We told you about our Pioneer position. We came in at 201. Unfortunately, we got stopped out at 190. Oil and gas is getting hammered right now. Just mentioned that West Texas Intermediate was at 67 and change today. I think we're going to take a look at maybe picking up Pioneer again because we find it in the low 180s. I like that very much. We bought Goodyear Tire today. You'll see that in our portfolio. We picked it up at 1010 today. Our Meta and Google and Tesla continue to thrash a little bit. Intel is getting very, very close to that 29 that we like. We're at 28 and change, and I have to tell you, with the volatility in the market, it was up a little bit today, despite the volatility in the market, and that's the only reason why I continue to think I'm going to hold the position and squeeze just the last little bit. But I have moved our trailing stop loss up behind it to the tune of 2%. Typically, I let that trail at 5. We've moved it up real tight at 2% because I'm okay here. We picked it up at a really good price. We're going to end up probably making 15% or better on that position, even if it was to sell today. The DPST, we picked it up again. We like that a lot. It happened to flash down to $8.50. I think that's a pretty good price. I think there's a lot of hysteria surrounding the regional banks right now. And even though we picked it up the other day at $7.50, I think it's probably a little close here at $8.50. I feel comfortable with it. We'll see. We'll sit on that position for maybe a day or so. And if we get stopped out, we get stopped out. That just means we'll probably have an opportunity to buy it at 7.5. That's probably about all that's fit to tell today. So, as always, keep your powder dry, take your profits where you can, don't be greedy, take those profits.